So, hello, 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 and a massive hello to everybody. How's everybody doing? Rocking and rolling in a free world. No trade calls, no recommendations, or responsible own stuff here for educational purpose only. 13th of March, 2025. Let's see what's going on. More than happy to go on as long as we need to. Again, no specific timing or anything I need to discuss. Just going to do a little bit of a rundown on the market and happy to take any questions, any comments, or look at any charts anybody wants to discuss, any dynamics, any position anybody's managing. Don't hesitate to ask, and we'll go through it. Okay. Now, hey man, how's it going? Good to see you around. Keep in mind, today we still have data. We got core PPI, weekly jobs. We got a 30-year auction, so should be interesting. But again, right now we're still in the midst of a little bit of a decent correction. It would make sense to see a little bit of a bounce here, and let's do this, right? Let's see what's going on now. Volume. Hold on. Let me see if I can improve the volume. Okay, this should be better. Okay, right now this morning we got a little bit of tactical trading here. Some nice little setups for those of you who follow our action around the previous day range. You've got a nice little long trigger on Russell. It's a nice little TP1 done. It's a decent little trade. You've got a nice little short here on crude, TP1 also done, and you had a nice little long on the yen, right? So all things being equal, decent start to the day. We really can't complain, right? So I know a bunch of you guys are trading these. So again, remember, just manage them risk-free. It's a break even or a better trade, so nothing can go wrong. Don't worry about it from now on, right? Now, where are we in terms of the market? So broadly speaking, let's get on, we were looking at a couple of things, especially the Mag 7, and we said that this held the key and that this whole action was very, very heavy. We expected it to break to the bottom end of the range, and if the bottom of the range broke, we'd expect to see a whole wind of this November move higher, and that's pretty much what we got in a very aggressive fashion. And now we're getting a little bit of a pause, right? A pause which absolutely makes sense, right? So looking at equities, what you have to keep in mind here is that you could look at it two sides, right? One is all the Trump trades have been unwound, right? And I'm not going to talk about it in terms of fundamentals here. I just don't want to get into trouble. Let's just look at technicals. Here's we've unwound this whole pump. Now, where are we in the monthly cycle, right? We're here. This is a Thursday before OPEX March expiration. So the March expiration cycle is one of the strongest cycles of the year. March and December are the big boys, right? So all things being equal, bar any kind of headline risk, shock, or data announcement out of the blue or crazy data print here, you would expect OPEX dynamics to kind of take charge here, and everybody will be looking for some kind of a swing low to be set today and a possible rally all the way into next Thursday. Now again, maybe because that's the obvious trade, it's not going to happen, but if you look at the way we've sold off, it would make sense to see a little bit of a bounce also where we're looking at here in terms of the calendar, right? Now this unwind, our base case assumption is that a lot of things have to reprice. And again, I'm not going to go into why, but ultimately we expect 5,000s to print, right? We expect us to go back to that August low at least, right? To see that test. Naturally, you wouldn't expect that to happen in a straight line, okay? So shorter term here, assuming these OPEX dynamics do what they have to do, we get a little bit of a bounce here. You've seen very, very aggressive protection of the 55.50 all week, right? You have to pay attention when you see this kind of action. You can't short this aggressively into the low. Your base case assumption here, again, is going to be a little bit of a bounce. Now, what are the levels to the upside that you want to look at in terms of key zones? Well, first of all, not only did we mention that key 5,700, right? But I think here what you want to look at is any rally that can't get back above the confluence of this 10-day and the 200-day is really just a little bit of a corrective bounce. Now, funnily enough, this could easily rally all the way back into, 5850s, 50 back, 61.8. It could even rally all the way back into the yearly open and still hold this move, right? So that's the problem with bear markets, right? Bear markets, one of the footprints of bear markets are aggressive, rip your face off rallies, right? And that gets sold into, but you should be very, very careful here. Now, remember, you can't trade a market with VIX at 25 the same way that you're trading a market with a VIX in the low teens, right? So of course you're going to have to adapt. And the difficult thing in these kind of markets is that you'll see a lot of days where you have a very aggressive change of pace, right? What does that mean? Well, basically, you get these you'll get days with very, very aggressive moves, very aggressive ranges that break through previous day levels. You'll get days with very aggressive moves, but they stay inside the previous day range. You'll get days where we're just stuck inside days. The moves aren't that big as vol comes down a little bit, and you have to understand that you can't trade every single day the same way. So you have to adjust that. So when vol's really spiking, you want to widen out your stops, widen out your TPs, and drop your size. But equally, you don't want to get used to trading like a squirrel on crack when vol comes back down and when the market isn't moving, right? Or also, you don't want to be as aggressive or stubborn as you can get away with when vol's in the low teens, because you can kind of get away with murder, or you can get away with being a little bit sloppy, but you really can't get away with that with a VIX in mid 20s or higher, right? What else? So, and again, here it also makes sense to see this rally. Remember, VIX is the only true mean reverting instrument. So, makes sense it'll come back down, get a little bit of chance to rally. So here on equities, I think what you want to watch is, again, how we trade into next week. The key things are going to be to the upside, the confluence of this 5,700 protecting the 10-day and the 200-day, and any rally into there that fails, you would expect it to come right back down. If we get a day close above, then the base case scenario should be that we could come all the way back into the yearly open price. Now, because this is a natural bounce zone, right? This is where you expect the market to bounce a little bit, also in terms of seasonal, etc. If we break, right? If we break, and especially if we get a day close below 5,550, you would expect to see something like a down 3 to 5% day. You'd see a very, very ugly flush. And again, keep in mind, I think here we've got a situation, we've been discussing this in detail in the webinars and the weekly outlooks, where retail, since this high, retail has been continuing to buy, right? Whereas hedge funds and CTAs have been unwinding very aggressively. My base case here is that, long only funds, professional managers haven't really started to unwind yet. They're waiting either for a flush from here, maybe to get back long, or if we trade this heavy, any rally to unwind. So I think you want to be very, very careful here. This is not a market where you want to be lazy, but this is, so far 2025 is God's gift to trading, because you've had a lot of trading, a lot of vol, big ranges, plenty of stuff to do. So we really can't complain. Okay. Now, if you look at some of the other charts, also what's interesting is that if you go back and you look at RSP, right? Also, this is a key level for RSP. You can go back. We've discussed this chart many, many times. And unless you see this stabilizing back again above the 171, 173, this looks very, very heavy. You'd be looking at 164 to the downside and the yearly open to the upside. Now, looking at some of the individual names, none of them are really in bounce zones, right? You could see Apple has filled this gap, but it's really nowhere close to a really interesting buy zone. AMD trying to base here, but still looking very, very heavy. Amazon managed to get back above the 200 DMA. This is potential bounce zone. This is an interesting one. Microsoft is still in the middle of nowhere. Facebook, we were discussing when we this week when we came back into this level, this was the only interesting buy back into the confluence of the 200 DMA, the yearly open, this previous high, and off those lows. We've had a very, very nice very, very nice bounce off that yearly open. Yesterday we're up as much as 7% on this, but even Nvidia still looking very heavy. It's not a technically it's not, you don't have everything at key support zones where you'd expect them to bounce. I think it's more of a OPEX and seasonal kind of where we are in the calendar. Also, Tesla's still looking extremely heavy. Bitcoin, another one where key action here. This is a potential bounce zone. I think everybody's waking up to the fact that they didn't get anything that they were hoping to get on the Trump presidency here. So you have to be extremely careful. Here, if the market rips, because essentially this is just, trades with risk, you wouldn't be surprised to see this try and make its way back into the 90,000s. But especially if we take out this low, I think nobody's going to want to try and catch this, before we're in the 50s. So this, again, it's also not looking particularly pretty, right? Gold kind of hovering here. With the way the dollar's trading, with the way everything's trading, you'd expect this to continue to stay bid. You'd expect to see that 3,000 attracts. That 3,000 is likely going to be a key, multi-week, multi-month bull bear line. We'll have to see how that trades there. And right now, we're at a ideal place to see a little bit of a bounce in the dollar, even though it's still trading extremely heavy here, right? And what I would be looking at is, even though it's flattening up, I'd be looking at this 105 as a kind of pivotal zone. We're still inside that 109, 106, 103 range. But globally here, I think that with a VIX in the mid 20s and equities trading the way they're trading, I don't really see why anybody would want to be trading FX. And you guys know I trade a lot of FX, but really there's very little interest in trading FX when you've got so much opportunity on the on equity side, so much movement and such technical action around key levels, right? So we had a question on GPB, JPY, and here, this is kind of hovering here. This is a little bit of a, I'd say, dog against dog kind of chart where nothing's going on. I don't trade this. I think there's very little of interest here. I don't know if you're looking at a specific trade here, but Daniel, what I would say, if you're bullish GPB, I'd much rather trade that against the dollar. And if you're bullish or bearish yen, I'd much rather trade that against the dollar. You're going to get far better liquidity, far more technical action. Here, what we're seeing, if you're looking on a daily, well, it looks like you're trying to get some kind of a base here. You see this pressure here that is failing, so it looks like it's trying to break up, and you could see a little bit of a rip going here. Now, this is going to be caught between two things, because you'll have the action, the general action on the dollar, general action on euro and cable on one side, and the other side, if you get that, that's still money going into JPY with rates going higher. BOJ clearly is going to continue to hike rates. This could be stuck in the cross currents, right? So what you'll likely see is that those two cross currents, that's when I talk about, dog against dog, means that it can't move as much. So you're likely going to get a much better bang for your buck on GPB USD or USD JPY, if you see what I mean. Those cross currents are going to keep it stuck, are going to stop you from getting the Momo you likely want. And especially if you're looking at it in terms of a rates play, if you're looking at it in terms of a fundamentals play, this is probably a suboptimal way to express that view, whether it's on GPB or JPY, because you'll get the more move and the more bang of your buck on the major, not on this cross. Okay? Let me know if that answers your question. Okay. As a general rule, again, not to tick anybody off, usually, right? Let me see if I can avoid getting in trouble. Usually, and this is the case for everybody, it's normal. when you start trading FX and, you know, you start reading the forums, the people on Twitter, the different YouTube videos, yada, yada, yada. Again, I'm not trying to get in trouble. What you will see is you will see a lot of the educator gurus or newsletter writers will talk about the crosses or exotic pairs, yada, 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 yada. Okay. But most often than not, that's not where you're going to get the best bang for your buck. That's where you'll get the worst liquidity. That's where you'll get the worst fills if you're not trading on a really good broker. And that's where you're likely going to get caught in a lot of cross currents that you could avoid if you trade the majors. So I know nothing. I'm just a dumb trader. But if I can offer any piece of advice to any newer trader, I'd say focus on the majors. If you make it 10 years in this business, you'll thank me later, right? That's again, I don't make the rules, right? I'm just trying to help. Again, Daniel, not trying to be a pain, just trying to help you, okay? So somebody asked about NASDAQ. Again, there's no right or wrong in trading. I'm just giving you my view, right? Yeah, Vic, you know, you can't handle the truth, right? So, NASDAQ, what's going on in NASDAQ? Let me know if you have a specific question in NASDAQ, but essentially NASDAQ is trading, like we talked about that Mag 7 chart and market in general. Basically here, what we're getting is we're getting a general unwind, right? Now, what pushed the market? What's been pushing the market all these years, right? Basically Tesla, Nvidia, Fangman, yada, yada, yada. So here, if we have to reprice, whether it's a general repricing on economic expectations, whether it's de-risking on people just having to take their exposure down because of a little bit of a panic, vol shock, whatever it is, the same ones that led to the upside are the ones that are going to lead to the downside, okay? And especially even if you're going to get a rotation back into other stuff, this is going to continue to get hit. So what you would expect is the weakest to stay weaker and the strongest to stay stronger. So here, NASDAQ, similar to everything else, probably has a lot more to go to the downside. If you want to look at the bigger picture, right, what I would focus on is fibbing this low into this high. Okay, let me know if it makes sense. So basically what this is giving you a 50 back, which is pretty much in line with this previous high, okay? If we want to be a little bit less scientific about it and just keep it easier, right, what we could do is we could just call it 1700, okay? So that's the downside. If you look at that 1700, right, off those highs, that's telling you basically you've got something like 24% correction. So that is not crazy. Now, I know people are not used to it in markets, but that's absolutely not crazy. That's absolutely doable. So here, if you're looking at a little bit of a correction of this excess of this kind of move, a natural target, if you're very bearish and you don't think you need to buy every dip, right? Here, you would be looking at that 17,000 in terms of downside target, okay? Let me know if you have a specific question, but I'll go through the timeframes here. So shorter term, what I would look at, you know, you could look at the 50-day on the weekly, or you can look at the 200-day on the daily, and it's the same kind of discussion, right? And what that means is here, because of where we are on the calendar, you'd expect to see a big fight to hold a short-term low here, 55.50 on ES defended. As we said, we've been talking all week, you know, we've been trading short aggressively, and starting from, you know, that first test of 55.50, we'd be saying here the trade is long, right? The velocity of try to scalp to the long side. So here, you know, what you would be looking at, as long as this holds, right, you'd be looking for us to try and come back into that 10-day and that 200-day. This, if the move is strong, this is a natural place where you should see sellers coming in and pressing for a new low. Now, what's interesting, of this 17,000, remember what we said on ES, we fully expect an unwind to go back to the same kind of rates panic we had on BOJ in August last year. So we expect this level to get tested. There's no such thing as a bad take. This was made overnight. So usually you'd expect this to get tested. So the first logical test on this bounce is that this could easily ramp all the way into that 10-day, 200-day. Above that, day closes above the 200-day, you would expect the market to have an explosive squeeze chance to go back into unchanged on the year, and sellers coming in there, then your base case assumption would still be that the move is in play for a move back into 17,000. Okay. So here, even, that 50 back is really normal. And if you think the way everything has moved, if you look at the drawbacks we've seen on stuff like also, all the charts, right? That's really nothing. I mean, don't forget Palantir here, off those highs come back 40%, right? So again, clearly we'll have to see. It's not the same thing on an index than a single stock, but that 17,000, if everything continues to trade the way it does, unless we get a big policy shift from Washington, unless we get something from the Fed, unless we get crazy shift in terms of data, whatever, that's entirely doable. It's not crazy at all. Okay, it's not crazy at all. Okay. Any comments, any questions, anything anybody's looking at, anything anybody wants to discuss? What else have we got that could be interesting? Again, I'll go on as long as people have questions. I'm trying to think charts that people might be interested in, because I know people are shy. Yen, no big change. We traded short last year. We covered into the end of the year, and our first trade from December, we went home saying the first trade we're going to put on first day trading back in January was to get back short USD JPY. Needless to say, this has been working quite nicely. Base case assumption, again, is that we need to, at the very least, come back into the 140s. Would not be surprised to see if we print sub 30s this year. Here, keep in mind that if everything rallies, we get a little bit of a pop here. Wouldn't be surprised to see this try and catch people off guard and maybe move all the way back into the 152 level. Keep in mind, we're going into the end of the Japanese fiscal year, so it's not uncommon to see some kind of shenanigans, but clearly no change on the USD JPY trade as we've been discussing for the whole year. In terms of longer term trades, you'd wait to get those. So are you talking about getting back long for a retirement portfolio or 401k, pension money, something like that? Yeah, everything, Angela, everything's just rotating higher this morning, right? It's the same, it's the same, it's the same trade across the board, right? Bam, 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 bam. It's just the same trade across the board. Nice little action, nice action this morning. So, Luca, I'm assuming you mean for longer term buys. What I would say in terms of longer term buys, the key thing is that you never know what's going to happen, right? So none of us know. Nobody has a crystal ball. And the problem with saying, I'm going to buy this at this kind of level, usually what tends to happen is once you get that level, it looks so ugly and so heavy that you don't end up buying it, right? You give yourself reasons. So if you're looking for multi-month swings, stuff like that, what you need is either you need to wait for some kind of a catalyst, right? So what's happening here, right? Trump's telling you he doesn't care about the markets best, and everybody's been very vocal since the beginning of the year, even though people don't want to listen. And the point is, they're going to put through as many things to put through to put everything in early, which causes short-term pain, and likely, the whole admin, unless it's the unless it's the Fed side and things get super ugly, has little all incentive to push everything as soon as possible, and then try and ramp things up for midterms, right? So I would say if you're looking at it that way, you're just waiting to see a shift from Washington, some kind of catalyst from the FOMC, whatever, something that brings money back in. And that could be Washington, that could be the Fed, or that could be a huge liquidity event with a massive flush lower and a big wick reversal. And then you try and get back long and you say, okay, the low is in, right? Now, the other way to look at it, which if you're less tactical and if you're not in front of the screens all the time, is just to pick your levels, right? So that means everybody's going to do it different ways, but you're going to go through the charts, look at all the names you're interested in, whether they're single stock names, whether in the indices, and you're saying, okay, this is a level at which I would be happy holding this for the next 10 years, right? And then what you do is either you just put your order in the system, or you scale in, say, 5 to 10% above, 5 to 10% below, 2 to 3% above, 2 to 3% below, and you just wait and you leave your orders in the systems. But the key point is you have to do your work ahead of time. If not, if you're looking at it, trying to analyze it real time, 9 times out of 10, people are just not going to chicken out or not going to buy it, right? So, for example, in the weekly videos, we've been going through this. At the beginning of the year, I laid out 8 names, which I'm looking to ETFs and single stock names, which are, long-term plays for the year and beyond. And what we've started to do is, layer orders down, right? Independent of what the market's going to do or where we're going to be, there are numbers at which we're happy owning it for the next, 1 to 5 years, whatever that play may be. Some are more tactical, some are more long-term, and irrespective of what happens, those are the orders are in the system. Now with these kind of plays, remember, I'm always looking at these in terms of non-levered play, 1-to-1, no leverage. So very, very zen. As long as you've done your homework, then you just let it do. The worst thing you can do is try and catch them with leverage. Then you really get into trouble. But if you're asking, do I think the low is in for 2025? No, I don't think the low is in for 2025. It could, but that's not my base case. That's the way I'm looking at it. Okay. I'm short Euro USD on a swing basis, targeting the 50 back of the recent up move. What do you think? Of course, I know nothing, right? But let's look at this. So you're short Euro, looking for a move to the 50 back of the recent upswing. So you're looking for a move back in 0560s, right? Hey, my pleasure, Luca. Now here, I would say that if I'm assuming this is a higher time frame play, right? If I'm looking at it technically, I see no reason to be short here. Okay. If I'm thinking about it in terms, okay, we're going into this expiration cycle, I expect equities to catch a bid, a little bit of a squeeze higher because everybody's been shorting into the hole. Then that should mean the dollar should come back down. Yeah, that would make sense. Now, the problem with the 50 back is going to be the 107 level, right? And I think this is just going to be down to equities, right? So it's what I was saying. I think here the point is equities. It's all about equities, and you'll get a far easier read and a far better bang for your buck there than on FX, right? Because it's likely going to be mechanical flows on equities that are driving the moves. So I'd rather put it this way. If you're short euro here, I think long equities is a far nicer play. It's going to be the same, but there's a chance where you get paid on equities, you don't get paid on euro. If you get paid on euro, 100% you'll get paid on equities, right? So again, here you have to keep in mind euros also. There's a lot of repositioning here. It's a tricky trade. I think you've got better ways to express the same idea, but yeah, I mean, if you're looking at it here on the 4-hour, you had a nice little reversal. So basically what you're looking at here, you see how basically the 10 on the 4-hour here, this is breaking down. It's looking good. As long as it holds below here, you could easily try and tighten up your stop. If this goes, it should go fairly quickly. And so you also have this that's breaking. So, you know, it looks like this could easily come all the way back down into this lower end of this range, 107.50. And, you know, if it can get traction and break there, then you could be home free into your 50 back, right? So again, everything's trading in sync. It's a very similar trade. Not a crazy trade. It's not, I think you get a better bang for your buck on equities, but it's not a crazy trade at all. Yeah, here the move on the dollar move is mainly against euro, right? Euro cable. Keep in mind there are a lot of other dynamics going through, so especially DXY is mostly euro. So, you know, I wouldn't, the commodity currencies are another game, right? Are another game. Don't look at those. Don't look at those to help you or to give you clues. They're likely just, you know, it's just they'll be trading here, especially through tariffs, through this unwind with what's going on. They'll be trading separate. You'll see that USD, euro, and cable trading separately to those commodity currencies. They won't be completely in sync, and definitely the size of the moves won't be the same. Man, Angela, you're breaking my heart with this Euro AUD. I'm joking, of course. Euro AUD. Again, Euro AUD. Yeah, I mean here, what's it? It's strong. It's one of the strongest. You've got on the way back down, you've got key previous resistance that's going to be acting as support. You've got this key previous resistance acting as support. And you've got that 10-day coming in here, right? So even if this comes down, you're going to get a far better bang for your buck shorting, you know, euro or expressing that trade on equities. So here it's similar to euro. It could easily try, if it can flush this zone, it could come back into this, which kind of starts to look like the 50 back of this move. So it needs to clear here, but you've got a lot of support, a lot of key levels to get through, right? Got a lot of levels to get through. Euro GPB, again, similar kind of hovering. You've got a lot of downside resistance. You're likely not going to get the same bang for your buck you get on euro on cable here. Is it stalling? Yes. Is it holding a whole series of lower highs? Yes. Could this be coming back into this mid-range? Sure. Right? Probably looks like it might have a freer way to the downside than Euro AUD. But again, well, it depends where you got short, right? Because if you're getting short here and your stop is up here and you're looking for the for the 50 back of this move, then essentially risk reward is horrible. And by the way, this is a messy one to fib because you're fibbing something that has a lower high and a higher low. So I wouldn't be looking at it that way necessarily. But yeah, not a crazy trade. It's hard for me to answer simply because I wouldn't be trading this at all. There's no risk reward that would make this interesting for me to trade. Any of these, whether it's GPV, JPY, GPB, CHF, Euro GBP, Euro CAD, Euro Aussie. It's just not something I would trade. It's not a crazy trade, but it's hard for me to give you a good answer, I think. Hope that helps. Any comments, any questions, anything anybody's looking at, anything anybody wants to discuss? Yeah, Vic, we're not looking at that at all. I think here, again, if there's any more questions, I'm happy to go on. Been going for about 36 minutes, but again, I can stay on another hour if there are enough questions. I have no problems. But here, what I would say is, really, guys and gals, these are ideal trading conditions with the Trump administration, what's going on in the world. We should be continuing to get an awful lot of volatility. We should be continuing to get an awful lot of really good trading conditions across the board, right? If you're traded, whether you're trading day trade, higher time frames, this is really a key time for you and beautiful year. So this is a year where you need to shine and where you need to make hay when the sun is shining, and a year that is likely going to offer an awful lot of opportunity. Equally, if you're not disciplined, this is the kind of year where you're going to blow your account. So adjust the pace, be disciplined, understand that you can't trade a VIX in the 20s the same way you're trading a VIX in the 10s. Understand that because of the bigger ranges, the biggest volatility, you should most likely, and you can easily afford to trade with far smaller size and end up with the same results, but because there'll likely be more opportunities net, you'll be better off even if you're trading smaller size. And more importantly, don't get sucked into having a bias. Don't get sucked into the political drama. Don't get sucked into loving Elon or hating Elon, loving Trump or hating Trump, and letting that dictate what you think is normal or what you think the market should do. Focus on the levels. Focus on having a repeatable system and mechanically executing without bias. That is really the key. Okay? Let me see. Can you look at the 10-year yield? Here we're kind of like in a little bit of a wait and see scenario, right? With basically some people thinking that we're going to be stuck here for a long time. A lot of guys crying for we're going to break above 5, and other people saying that's it, we're going back into the 3s. I think the best way to look at this, again, bar any headline, is just to let price tell you what's going on. And essentially what you can see here is that essentially, whether you're looking at the yearly range, you've kind of stuck inside this area. I think more importantly here, unless something drastic happens from here on, I would expect us to stay inside 4 and 4.5, right? I think here the bar is fairly high for us to break and hold outside. So what you really need is a strong catalyst, right? And I think for now yields have come down, so Trump's happy, Bessent are happy. They probably want them lower, they probably need them lower, but for now we're going to be stuck here. And, and you can see this ultimately whether you're looking at the action in UB, ZB, ZNs, right? What's happening in this whole unwind in the market? Essentially, bonds have been fairly stable, right? And they're waiting for the next catalyst, right? So you just have to be a little bit patient. Yeah, Luke, and if you look at TLT, it's the same thing, right? It's the same thing, and whether you're looking, so you could see here, we're kind of stuck, right? With that 9180s is still, and has been for a while, a key pivotal level. And as you can see, it's the same thing for UBs. We're stuck at the pivotal level. ZBs, ZNs, everything with a little bit of a heavyish tone coming back, a little bit of a heavyish tone coming on, but broadly speaking, we're still inside that range. So we just have to be a little bit patient and wait. I think here the next key thing, again, bar any shock, what you would expect is to see some kind of pause here as we get through OPEX, then maybe very messy trading in the back end of March, depending what happens. Maybe the week after OPEX, we get a little bit of a heavy flow, and then they try and jack it up with a month-end, quarter-end markup into the end of March. And then it all starts again in April, right? Because remember, 2nd of April, we get all the tariff stuff's going to be back on us, right? So likely here we've got a little bit of a 2-3 weeks where the market is going to be in the hands of technical, mechanical flows, price insensitive flows, and then everything starts. What we've been seeing on this tariff drama, everything else gets to start again in April. Okay, that's the way I would be looking at it for now. But as usual, views can change in the next 2 seconds, right? As always, we have to let the price tell us. We're dependent on price. That's the only thing that we know, price at levels. Okay. Good stuff, guys. So thanks for hanging with me today. It was a pleasure. Again, we'll try and do this next month, 3-4 weeks time. And again, have an awesome one. Thank you so much. Thanks for flying with 50. Talk to you guys soon. Take care. Bye-bye.